If you live in Poland and want to invest in global or Polish stocks, but you are confused by brokers, taxes, or where to even start, this video is for you. This is a simple beginner guide for people living in Poland. Whether you are working here or just moved, you learn 3 easy ways to start investing in stocks from right here in Poland. Also, at the end of the video, I tell you what is my favorite way of investing. And before we start, one disclaimer. I am not a financial advisor and this is not investment recommendation. This video is for education purposes only. Alright, let's dive in. As a resident in Poland, you have 3 easy ways to invest in stocks. Mutual funds through your bank, individual stocks through a broker, passive index ETFs also through a broker. Let's go through each and see what works best for you. Option 1. Mutual funds. In Poland, these funds are commonly referred to as TFI. They are offered by most major banks such as PKO, ING and Santander. These are actively managed funds, which means that the fund manager selects the stocks that go into the fund. The main advantages of these funds are their simplicity and automation from an investor's perspective. You can start investing with as little as 100 zloty and everything else is managed for you. Additionally, these funds usually offer a diversified portfolio of many companies, which helps to reduce risk. For instance, if a fund holds 50 different stocks and one company goes bankrupt, the overall impact on your investment is relatively small. The problem with many mutual funds is that they have high fees and often don't perform very well. In fact, they usually grow less than the index they try to follow. This is called a benchmark. What is a benchmark? A benchmark is what we use to compare the fund's results. For example, if a fund invests in American companies, we compare it to the S&P 500 index, because that index includes the 500 biggest companies in the US, like Apple, Microsoft, and Google. Let's look at the real fund, PKO American Stocks. These funds only invest in US stocks. Its benchmark is the S&P 500. So to see if the fund is doing well, we compare its results to the S&P 500 index. In the last 10 years, the PKO fund grew by 137%. The S&P 500 measured in Polish zloty grew by 228%. That's a huge difference. This means that the fund gave much lower returns than simply following the index. And here's something important. This one fund is not an exception. There's a website called kupfundusz.pl where you can compare the performance of different funds. It also shows the average results of all Polish mutual funds in the same category. If you check mutual funds that invest in the US stocks, we see that the average return over the last 10 years is only 96%. Let's say that again. In 10 years, the average Polish mutual fund investing in American stocks returned 96%. The S&P 500 index, which is the benchmark, returned 228%. If you invested 10,000 zloty in the average fund, you would have over 19,000 zloty after 10 years. But if you invested the same amount directly in the S&P 500 index, you would have almost 33,000. That's a huge difference. This poor performance of investment funds doesn't only happen in Poland. It's the same in the US. For example, between 1991 and 2016, US mutual funds that invested in large companies made an average return of 7.8% per year. But during the same time, the S&P 500 index gave a better return of 9.1% per year. Initial investment of $10,000 translates to over 79,000 in returns using simple S&P 500 index versus only 55,000 what average fund returned. If we look at the longer period, from 1970 to 2016, there were 355 mutual funds in 1970. By 2016, 281 of them, almost 80%, had closed down. Only 10 of these funds did better than the S&P 500 during this time. That means investors had only a 2.8% chance of picking a fund that beat the market, like trying to find a needle in a haystack. Why are the funds giving so much lower returns compared to the simple index? First, picking the right stocks is a very difficult task. As you can see, even professional fund managers struggle to beat the simple index. Second, fees. These funds usually charge high annual management fees between 0.7% to even 3%. This is a fixed annual fee which is being charged, doesn't matter if the fund performs well or not. At first, such a 2% fee might not sound a lot, but in the long term, it's devastating for your gains. Let's illustrate this with an example. Let's take two investments and assume both of them are returning on average 8% gains annually, which by the way is similar to what US stocks were returning in the past. First investment doesn't charge any management fees, so every year the 8% is your net gain. Second investment charges 2% annual fee, so your net gain is 6%. In short term, it is not a big deal. Assuming investment of $10,000, after 1 year, you would have $10,800 in zero fee scenario versus $10,600 in two fee scenario. But magic happens in the long term. After 10 years, in no fee scenario, you would have over $21,000 versus less than $18,000 with 2% fee scenario. After 20 years, it is $46,000 versus $32,000. After 30 years, it is $100,000 versus $57,000, which is already a huge difference. Thanks to compound interest, the difference is growing each year. And after 40 years, zero fee scenario would lead to $217,000 versus $102,000, which is more than double. Those high management fees are the main reason I don't like mutual funds, and personally, I do not invest in them. The second way to invest in stocks is to choose companies you like and buy their shares. For example, if you live in Poland, you can easily buy shares of companies from around the world, like Apple or Google from the US, Mercedes from Germany, or Orlen from Poland. But as you remember from previous chapter, even professional fund managers, people with finance degrees, full-time jobs, teams of analysts, and the latest market data often fail to beat the market. So if they struggle to beat the market, what are the chances of a regular person like you or me to beat the market? The chances are very low. In fact, there are studies which prove this. According to studies by Dalbar and JP Morgan, the average investor earned just 2.6% per year between 1998 and 2017, barely above the 2.1 inflation rate. Now, compare that to the S&P 500, 7.2% annual return over the same period. That's a massive difference. So why do individual investors perform so poorly? There are a few reasons. First, picking the right stocks is incredibly tough, even for professionals. But beyond that, retail investors often trade too much. For example, someone might buy Google shares, but when they see Nvidia doing better, they sell Google and switch to Nvidia. That constant switching means more transaction fees and unnecessary taxes. Another big issue is trying to time the market. Buying low and selling high sounds great in theory, but in practice, it rarely works. Most people end up doing the opposite. They panic during market crashes and sell when the prices are low, locking in losses instead of gains. Honestly, I'm not kidding myself. I am not a pro investor. I don't have time and tools to pick the right stocks on my own. That's why I don't do it, and I don't recommend it neither. Since most regular investors and even professional fund managers usually underperform indexes like S&P 500, the question is, can you invest in the index itself? Yes, you can. And that's exactly what the third option is. ETFs. ETF stands for Exchange Traded Fund. It's an investment that lets you buy a whole group of stocks in one single purchase. For example, all the companies in the S&P 500. Think of it like a basket filled with the 500 biggest companies in the US. Companies like Apple, Microsoft, Google, and so on. You can buy it just like any stock. It's simple, low cost, and great for beginners. When you buy an ETF that tracks the S&P 500, it holds the exact same companies as the index. If a company in the index performs poorly and drops in size, it is replaced by a better performing one automatically. Because the rules of the index are clear, ETF managers don't need a big team of analysts trying to guess what company will win next. They just follow the index. That's why ETFs are called passive funds. They don't try to beat the market, they simply follow it. And since they don't need to do much buying or selling, the fees are very low. Now, let's look at some ETF examples available in Poland. If you want to invest in the S&P 500, two popular options are the Vanguard S&P 500 ETF with a ticker VUAA, iShares Core S&P 500, ticker CSPX. Both have a super low fee of just 0.07% per year. Compare that to 2% or more charged by many mutual funds. Want even more diversification? You can buy an ETF that holds stocks from all around the world. For example, iShares MSCI ATSV ETF, ticker IUSQ. This ETF holds over 2,300 companies globally, with about 60% in the US, because the US currently makes up most of the global stock market value. You can also find ETFs that focus only on developed countries, emerging markets, or even just one country like Poland. So which ETF should a regular person choose? In my opinion, most people should focus on one of these three options or mix of them. 1. US S&P 500 ETF. The US is still the largest market, 60% of global value. Historically, it has strong long-term performance, better than most of other markets, and fees are very low, just 0.07%. Global ETF. It offers slightly lower past returns than the US alone, but offers maximum diversification across the world. You still get 60% exposure to the US, plus protection if other markets, including emerging markets, start to grow faster in the future. And 3. Developed Markets ETF. A good middle ground. You avoid the risk of emerging markets, but still get exposure outside of the US. Personally, I think the wider the diversification is, the better. Especially for investors like us, who don't have time to pick stocks or analyze markets every day. Before buying ETF, just look at the expense ratio. Anything lower than 0.2% per annum is fine. So how can you actually buy such an ETF? First, you need to open an account with a broker. When choosing a broker in Poland, look at two things: how safe and trusted the broker is, and how much they charge in fees. I'm not sponsored by any broker, but I personally use and can recommend two in Poland: XTB and DM Bosch. XTB is great because you can buy ETFs with zero commission as long as you don't go over 100,000 euros in trading per month. DM Bosch charges a fee of 0.29% per trade with a minimum of 14 zloty. If your ETF is in a currency different from your account, both brokers will charge for a currency exchange. XTB charges 0.5%, DM Bosch charges only 0.1%. To avoid these fees, you can open an account in a foreign currency. XTB offers accounts in Polish zloty, euro and USD. DM Bosch offers the same, plus British pound. If you are interested in retirement accounts, both brokers offer them. XTB offers IKE, but only in Polish zloty. DM Bosch offers IKE and IKZE also in Polish zloty. But with DM Bosch, you can convert currencies inside these accounts, which can help lower costs when buying or selling ETFs. Another plus, XTB has a modern and easy-to-use platform in English. Bosch currently only offers a platform in Polish. Since both brokers are based in Poland, they also prepare your PIT-8C tax report, which you'll need when filing your annual tax declaration. That's a big help, because you don't have to calculate the taxes yourself. You can also use foreign brokers like Interactive Brokers, which is well known and has very low fees, but there are downsides. You can't open Polish retirement accounts like IKE or IKZE. They don't help you with Polish tax documents, so you'll have to do that yourself. Because of these reasons, I personally stick with the Polish brokers. And that's it for today. If you don't want to miss future videos in which I explain how to invest in Poland, make sure to subscribe to the channel. Also, please leave a comment down below what topics you would like me to cover next, as I want to make content that's useful for you. I'm Piotr from MyInvest, and I see you in the next one.